You know what? When you think about the consideration of an income plan, one key to think about is taxes. Having a tax efficient strategy for your income, particularly if you're not going to return to the workforce, is important to ensure that many of your hard-earned dollars stay with you and not the government, right? They support you, not Uncle Sam. Many of the people that we work with have not had a diversified strategy in place when it comes to their future tax outlook. They might be diversified from an investment standpoint, but they're not diversified from a tax standpoint. And, they're busy just saving for retirement, but not necessarily thinking about what their income is going to look like when it's time to put those savings to work for them. And if that's you, don't worry. We're going to talk about some of the potential options to help address that. So what we've got here, for example, is the 401k. That began placing traditional pensions in around the 80s. Has a downside that many of us don't always think about when we're just socking money away every single month. And those 401ks or 403bs, 457s, traditional IRAs, whatever, most of those traditional tax deferred accounts, what that means when I say tax deferred, I mean, you got to enjoy a tax savings when you contributed the money, and that money went straight from your paycheck into your retirement account, usually with no taxes deducted. So your take home pay was, a little higher based on if you would have invested after tax. But you got to understand the key word here is tax deferred, not tax free. The government is eventually going to want their share from those in the form of taxes. And that's as soon as you start drawing from that account, you're going to pay at the rate of whatever tax bracket you're in at that time. Sometimes that's a lower tax bracket, but we're finding many retirees, a lot of our clients also, are in the same tax bracket or even a higher tax bracket in retirement, especially if they've done a good job saving, because Social Security is now taxable too, up to 85%. So here's what I don't want you to think, if I don't need the money, I just won't take it out. You're not getting off that easy, because now starting at age 72, you have to start taking required minimum distributions. We call them RMDs in the industry here. You got to start taking those from your account. And if you don't, there are some additional penalties along with that tax bill. So what are the moves that you can make with your income plan to potentially reduce some of those taxes? Well, we recommend diversifying your assets among at least 3 different buckets for a tax-efficient retirement income strategy. You've got the taxable bucket, and that's assets like your savings, money market accounts, CDs, investment accounts, basically anything outside a qualified retirement plan. And the way you know whether or not you have one of these is you get that love letter from the IRS every single year, even if you didn't pull any money out. That love letter is a 1099. Right? If you get one of those, here's how much interest you made, or here's how much dividends that you made. If you get that and you didn't take any money out, that's a taxable account, or we call it after-tax account. Tax deferred category represents most retirement accounts, 401ks, 403bs, like we talked about, 457s, simple IRAs, traditional IRAs, SEP IRAs, profit sharing plans, pension plans, all of those. And third, income tax free. There we have Roth accounts, like Roth IRAs or even Roth 401ks right there. And so let's talk a little bit about that Roth option. So traditional IRAs, or, individual retirement accounts, they fall into that tax deferred bucket. They allow you to put pre-tax dollars in, and then those dollars go tax deferred, meaning you pay no taxes on the growth until you start taking withdrawals at whatever age 59 and a half or beyond. And with a Roth, on the other hand, you pay the taxes up front, so you don't get a tax deduction. But with the Roth, you don't ever have to pay any taxes later. When you start taking distributions in retirement. Another perk, unlike a traditional IRA, the Roth IRA, there's no required minimum distributions, right? So you don't have to worry about starting to draw money from the account unless you actually need it. And one of the easiest ways to think about these two types of an account is, I'm going to use a farm analogy. I grew up on a farm, right? And farmers have to pay taxes just like everybody else. But if you were a farmer and you had your choice, which would you prefer? Would you rather pay taxes on your seed that you put in the ground, the little bitty seed, right? Or would you rather pay it on the harvest that seed generates? Because at the end of the day, that's really the difference between a Roth IRA and a traditional IRA. Roth IRA is the equivalent of paying taxes up front or on the seed, never being taxed again. Traditional IRA is the equivalent of paying taxes later on the harvest, right? When there's no telling what those tax rates might be at that time. And, your field just might blow up so huge that you've got a lot of taxes that you're going to have to now pay on that too. So I'd rather have that in a tax-free vehicle. So fortunately, the IRS does allow something that some of you may have heard of called a Roth IRA Conversion. Roth IRA conversion simply is a transfer of your retirement assets from a traditional IRA into a Roth IRA. You'll have to pay the taxes due at the time you do the conversion. And then that allows all the future growth and all of the distributions of that to continue on tax-free forever. Roth conversions, they've always been something to consider, but right now, for many, they may be even more attractive. And here's why. So there's two reasons a Roth IRA conversion could be an attractive option, for a lot of you right now. One, if you've been laid off or you're no longer working, this is potentially a rare lower income year for you. You may find yourself actually in a lower tax bracket for the first time in a long time. And number two, tax rates right now are historically low, thanks to the Tax Cuts and Jobs Act of 2017. So let's look at each of those two pieces here. So the conventional wisdom for many years has been, we'll all likely be in a lower tax bracket in retirement than what we were in during our working years. And what we're finding, like I said, is that's often not the case. A lot of retirees are in the same or higher tax bracket in retirement. But right now, if you've experienced a layoff and you're no longer working, your income will likely take a hit. And you may find yourself now in a lower tax bracket than what you were in previously. So two, taxes really, guys, they're essentially on sale right now. The Tax Cut and Jobs Act signed into law by Trump in December of 2017. They did make substantial changes to the tax rates for individuals, reducing tax rates at almost all levels and shifting the thresholds for several of those income brackets. But those tax cuts are scheduled to expire December 31st, 2025. Unless the cuts are extended by Congress, and we've all seen just how well Congress is able to agree on things these days, the 2026 tax rates are going to revert back to the pre-Tax Cut and Jobs Act levels. So in essence, back to higher levels if nothing is done. And how good is Congress at doing nothing? Pretty good. So, all right, let's take an example of a couple here. Say Andre and Alyssa, right? So A is easy to remember. Okay, they got taxable income of about $170,000 in 2017. Their highest marginal income tax rate would have been in the 28% tax bracket at that time. And for the sake of the illustration here, let's say they have stable income, no raises, no reductions. And today in 2020, with $170,000 in taxable income, their highest marginal income tax rate would be the 22%, not the 28, 22. And so potentially, there's this window here that we have, which tax rates could be lower for you, either because your income is lower this year due to your job loss, or just simply because you're in a lower tax bracket than you have been in the past because of the tax cuts, right? And so meaning to return to the concept back to, the Roth IRA conversion, you'll potentially pay lower taxes on that conversion today than what you would in the future, while also enjoying all the tax-free growth benefits that come along with it in the future too. I just say, with everything that's going on in the world right now, it'd be way too easy just to sit at home, right? Just say, all right, I'm just not going to do anything. Let's just wait or hope for things to happen. But as I've always said, hope is not a strategy. Hope is not a strategy at all. Now's the time to plant your heels and maybe like this guy with the boxing gloves, maybe fight back. I love that. I happen to be a martial artist. I got a black belt in Taekwondo. So anytime I see anybody with boxing gloves on, it just kind of makes me a little excited, right? So what you guys can do right now is time for you to define your next chapter, your next adventure. You get to define your worth, not somebody else. And no matter what your immediate future holds, whether that's a new career, whether that's part-time work, the opportunity to embrace retirement today, just know we're here. We're here for you. There's no greater satisfaction, I think, than helping people like you all figure this out. Figure how do I determine that next step? How do I move forward with confidence? Now is not the time to be worrying or wondering when you can be in control. Now is the time to know that you can be in control.